co-founder and CEO Bob Diamond. These quarterly updates have been terrific for me, and we're getting so much wonderful feedback. Mostly because you guys have been unbelievably diligent and prescient in understanding all these strange variables that go into what makes up the macroeconomic circumstance. And when we finished last quarter, the two of you told us two things that, in terms of how I interpreted. One is that we were at that time and probably still are living in a Larry David kind of economy where things are pretty good. And the other, which I've heard dozens of times, Larry, in terms of feedback, was that you thought a Fed rate cut at that time during the quarter we just finished would be almost irresponsible based on what you were reading in the economy. Well, now we have a few other things to think about. And I've heard you speak about how the global electoral cycle, Bob and Larry, impacts our economy, policy, and what happens as a result of those changes. And Bob is an expert on the UK, having lived there for over 20 years. We just had UK elections. Let's start with before we get to what the uh, tech bubble might or might not be, and other global issues, including wars in several parts of the planet. Bob, real quick, what do you think the outcome or the signals we should read from the UK elections?
Well, Jimmy, I have a strong bias here, having spent over 20 years in the UK and 16 years with Barclays, the premier UK bank. Today, we're owners of Kantor Liberum, a recently merged leading middle market advisory firm.
With a
But I
storied
will tell
history.
you, yeah, a storied history, over 150 years. But since 2008, the UK, both in the city, kind of the attitude toward business, the attitude toward banks relative to the US, really has been a drag on the economy. And when you add into that what most people believe with hindsight was a poor decision with Brexit, the economy has struggled. I think this is a great change. I think that after a number of years of weak leadership in the UK, Starmer is highly respected. With Maddox, he has a very strong and highly respected chancellor. And I think for the Labour Party to come in, counterintuitively to say, we need a strong business, we need a strong City of London, we need a strong stock market, we need strong banks, will have real credibility because it's not expected to be what their platform will be. So I'm pretty optimistic on the UK relative to the poor performance of the economy since 2008 and the poor performance of the financial sector and the city. I'm pretty optimistic, and I speak with putting my money where my mouth is we've just merged with Liberum and kind of doubled up in that middle market advisory space.
Well, Larry, we just saw a rally in the European banks, which is a bit of a surprise to me when you think of the macro issues that you pointed out about what's going on in Europe. And London, which was the financial capital of Europe, perhaps vying to be a financial global capital, doesn't have a reason to be a global financial capital anymore with the exit from Brexit. And that can't be undone. So we have a rally that says things are getting better in the banking sector. Bob, you said this election was a reaction to an economy that's been drifting since 2008. What can go better here for them? I don't understand what factors would lead you to think that London has a reason to be an economic powerhouse again? Certainly not a manufacturing powerhouse.
Is this to me? I mean, I just first of all, I agree with everything Bob said. Although I have to say the bar is kind of low. It looks to be that Brexit was a mistake. The economy's starting to grow again. I think the Bank of England will also come around to cut rates. So I think prospects are good. Given what's happened in the UK and the disaster, I think, of Brexit, it's not surprising there's a change in leadership. And in general, I was going to talk about this later, but Europe's finally starting to grow, and so just the euro area which the UK, despite Brexit, still has very strong trade links too, as you know. And the same with the UK. So I think they're starting to come through this well. They've lagged the US big time, but I think prospects are brighter. I take that, I mean, look, it's pretty safe to say that the economy and financial markets have taken a backseat to political news, but it's always the case that leaders get too much credit and blame for what's going on in the economy because there's a business cycle out there. It's what businesses, what households do that matters most. Policy has an impact, clearly, but I tend to focus on that, taking into account policy changes.
So what do we interpret from what happened in the UK elections? As you painted a picture for us last time, this global electoral cycle that we're going through with some of the largest democracies in the world having elections this year, and now this being an early indication, what does that portend for the others? Is there a return to practicality? Is there a return to competence? Is there something that's desired? And how do you find competence here in the U.S.?
Well, I wouldn't go that far that we're a return to competence by any means. I mean, we've had, look, recently we've had elections all over the place. I mean, you're talking about India, you're talking about Mexico, you're talking about South Africa, you're talking about France, you're talking about the UK. And with only 4 months left before the US election, we're not even sure who's going to be on the ticket at this point. And, so to say what the implications are, it's hard to say. I mean, Jim, we had an earlier conversation about a shift to the right. That's true in some countries, but it's not true in the UK. I mean, the Labour Party's taken power for the first time in 14 years. And in France, it had looked like the far right had a shot, but right now, it's not clear what the government's going to be, but it's not going to be a far right government, doesn't look like. So, and in the U.S., who knows? I mean, and by the way, look, I'm an economist. I'm not a political analyst. It's not my bailiwick. But what I'd like to talk about is what's going on in the U.S., especially what we can expect going forward, where we are in the business cycle, what the Fed's going to do. I realize that's not what everybody's talking about right now, but it's important, and that's the area that Bob and I are in. This is
macroeconomic, and those things are influences and stimulants and retardants all at the same time on the macro. Right. So what do you see in the U.S. now? You have all these things that could go wrong, but things seem to be going okay. We're dodging lots of bullets, and some of those bullets are big.
That's right. Yeah, I mean, we've come through this incredibly well, given the devastating effects of the virus. It produced COVID, and the policy stimulus that was enacted in response to it has produced an extraordinary business cycle that took most most economic analysts off guard, I think.
Except for you.
Oh, well, that's nice. Thanks, Jim. Well, we'll see going forward. But just for example, after inflation surged, Fed takes rates from 0 to over 5.25%. Everybody's expecting a recession. The opposite happened. Last year, the economy grew 2% in the first half, 4% in the second half. It actually accelerated. And usually a surge in growth means that you're going to get higher inflation.
Sure.
Inflation fell all the way to 2% in the second half of last year, which is the Fed's target. And this sharp drop in inflation led financial markets to think the Fed's going to cut rates big time. And the strength of the economy kept the Fed on hold. Meanwhile, what's happened so far this year? We're in the middle of the year already.
Yeah.
They've reversed these trends. Growth has now slowed and inflation's picked up. So before the Fed was resisting rate. Well, that's what I'm getting into. So before the Fed resisted rate cuts because the economy was too strong. Now they're resisting rate cuts because inflation's too high. So what do we think? We think the Fed is going to keep interest rates where they are at least through the summer. But I have to say, there's a pretty good shot they're going to cut rates by a quarter point before the end of the year, once, maybe even twice. So if you look at the inflation numbers through April, if you look at the underlying trend, as you know, the Fed focuses on core, it was running 4%. It was 2% in the second half. That's the Fed's target, it was running 4%. But we got the May numbers and prices barely rose. Tomorrow, we're going to get the June CPI, and it's likely you're going to get a very soft increase. So a little higher than what happened in May, but pretty soft. And if you see another month or so of benign inflation numbers, we're probably going to get a rate cut as early as September. So that's where we are. Now, if you look at, I think it's important to understand what's been driving this, these ups and downs in inflation in this business cycle. And to understand what's going forward, first step is understand why did this happen? Because you can look at these factors and see what's going on. All the action's really been in goods prices, right? We started out with a deadly phase of COVID, and everybody was stuck at home. Nobody was going out. Nobody was traveling. Nobody was going out to entertainment venues, restaurants, and so forth. And what do people do? They bought lots of furniture. They bought lots of office equipment, electronics equipment, exercise equipment to make life more comfortable at home and to accommodate working from home. And at the same time, we had this huge supply shortage, right? I mean, factories were closed, transportation workers weren't showing up. So you had a combination of strong demand for goods. This is all goods prices, even though they're only 40% of inflation, the rest of it is services. And you had a supply shortage, and that brought inflation to levels we hadn't seen in over 40 years. The drop in inflation occurred after vaccinations proliferated and the health of the effects of the virus faded. So good spending declined as everybody started going out and about and re-engaging in previously off-limit services. And by the time the second half of the year, last year rolled around, the supply chain went back to normal, and that produced a significant decline in inflation. Well, right now, this drop in goods prices, they came back down to earth, used car prices and that kind of thing. That's over. So now goods prices are stabilizing. Meanwhile, the service
wage costs seem to be stabilizing. I was reading in
right.
Deal Book this morning that they're saying what you're saying, which is expect a rate cut in September, which has been an echo chamber over the last week or so. But now they're talking about deflation in car prices, Larry.
Yeah, right. So prices of goods, some of them are going down, but overall they're stabilizing. Last thing we want to do is get into deflation.
Yep.
Japan stock, I don't know if you look at the Japanese stock market, it fell for 20 years after they went into deflation and the economy didn't grow. So you don't want overall prices, but yes, some goods prices are declining. Overall, I'd say they're stable, but the service sector, that's 60% of the inflation indices, has been on fire, right? People are making up for lost time. They're traveling again. They're going out to restaurants. They're going out to bars. They're going out to entertainment venues in big numbers. Inflation in service has been running 4 to 5%.
So you're saying this is all the fault of Taylor Swift?
That seems to be part of it. But anyway, the decline in goods prices brought inflation down to 2%. Now that goods prices are stable, overall inflation's moved back up. Now, of course, economic policy played a key role in this, and I'll get to the labor market in a minute, in all the gyrations of growth and inflation. I mean, we had historic, I won't go through the numbers, historic monetary and fiscal policy stimulus, which generated a huge rebound in the economy after it collapsed in the spring of 2020. And without that, the economy would have remained in a very depressed condition for much longer, and we probably wouldn't have gotten the increase in inflation at all. And all that stimulus provided a cushion to the economy. It allowed it to grow rapidly, despite this dramatic rise in interest rates. And these COVID relief policies lasted a couple of years. They created more than $2 trillion in excess savings, a boom in business profits, and also a huge increase in household wealth. But as you were referring to, Jim, an additional cushion was provided by the labor market. because the labor market kept creating jobs even as the interest rate sensitive sectors collapsed. Okay. So COVID generated a massive shortage of labor. Well over 1 million people died. Immigration was shut down. A lot of people were either sick or caring for somebody who was. A lot of baby boomers retired. A dearth of child care caused a lot of workers to stay home. Job openings went all the way to 12 million. That's a level never seen before. It was double the number of unemployed.
Wow.
Housing and manufacturing got crushed by the rise in interest rates like they always do. And usually what happens is you get layoffs in those sectors, that reduces income, and that spreads it to the rest of the economy. But this time, this huge shortage of workers allowed job growth to continue despite the layoffs in those sectors. And not only that, but the labor side was boosted by a surge in immigration, right? We've had massive migration around the world after COVID ended. And so in other words, what happened, instead of spreading to the rest of the economy when housing and manufacturing collapsed, we still had job growth. So if you add up the policy stimulus and the fact that job growth was still booming, that generated lots of income, and the consumers and business kept spending despite the tightening in monetary policy. So what about this year? Why did growth slow this year? Well, first of all, the labor market's now in much better balance. Also, a lot of those excess savings that were built up from all these COVID stimulus policies
Right.
have dwindled. People have been drawing upon it. So where are job openings now? I said they peaked at 12,
Yep.
twice the number of unemployed. They're now around 8. Normal's about 7. Meanwhile, the ratio of the job openings to unemployed, which is a key measure of labor tightness, no longer double. It's 1.2. 1.2 is within the normal range. We've seen the unemployment rate creep up. We've seen claims for unemployment insurance go up. And we still have high interest rates, and that's keeping a lid on manufacturing and housing. So all of this has produced a slower pace of consumer and business spending. Now, what does all this mean? We would characterize this not as more of a normalization of the business cycle following these huge swings. That's why it's not been that interesting lately. There's no signs at this point of an imminent recession. There's no doubt growth in payrolls has slowed from a very overheated pace, but it's still solid. I'm going to give you a little wonky statistic. When you look at the employment numbers, it gives you a good hint of what's going on from income. And what I like to do is there's sort of a payroll proxy for income. You multiply wage growth by total hours worked, which gives you a sense of income. That's running about 5%. That's solid. I mean, that's still enough to maintain consumer spending. Now, the unemployment rate's risen by more than a half percentage point. It's 4.1% now, but that's still historically low. And also, there's been, I referred to before, an enormous increase in household wealth because of rising stock prices, which I'll get to in a minute, and home prices. How much? The estimate right now is that since the fourth quarter of 2019, you're talking about a $19 trillion increase in household wealth, and that's after adjusting for inflation. So you add all this up, we're not looking at recession. What we're looking at this year is growth of around 2% in GDP. Now, last year it was 3.2%. That's slower, but 2% is consistent with what most economists consider potential growth. So what I want to get to at the end here is what kind of environment are we in now, and what can we expect going forward? So most of these COVID-induced swings are behind us. But I think we're in a different economic environment than we were before COVID and after the financial crisis. So after the financial,
what economic environment do you see us in now, Larry?
Okay, so the big news is after the financial crisis, you look at inflation and you look at interest rates, they were incredibly low. I mean, believe it or not, Well, I think everybody knows this. After the financial crisis and before COVID, inflation averaged under 2%. The Fed funds rate, the federal Fed's policy rate, averaged a little under 1%. Okay?
which is historically low.
Exactly. And I don't think that's what you're going to be seeing here. Um, if you look at the
So
factors
when we're saying to
that
return
kept
to
in,
normal,
that's what I think.
Bob has said before that, I
Yeah,
think you said, Bob, it was decades before '08 where the Fed funds rate was 4%, averaged out.
right.
And now we've
That's
had
right.
since then, let's call it a 1% rate.
That's
So
right.
when people say we're going to return to normal, you're saying it's not the '08 and beyond period, it's the pre-'08 period when federal funds rates was 4%, mortgages was 6%. And so
Right.
that seems like the new
That's what
normal
I
you're
think.
talking about.
And then let me explain why. Like
Yeah.
what's different, what's happened. I think the main thing that's different, if you remember, the Fed was having trouble getting inflation even at 2%, which is their target, right? And there are several factors that brought inflation down there that have changed. They're moving in the opposite direction. And there's a few of them. One is definitely increasingly free trade, things like just in time inventories. So, you run a business, Jim, so you know what I'm talking about. So, trade right now, you know, tariffs, trade restrictions, those are the order of the day right now. Businesses are keeping higher levels of inventories after those COVID-induced shortages. They saw what happened. They're also diversifying their supply chains,
Which
and
is
they're
hard, but
considering
everyone is on a steady pace to do it as best they can. You have to, as a
exactly,
steward of your balance sheet and as a steward of our assets, you have to say we can't be single source dependent.
exactly. And they're considering geopolitical risk. Before it was just cost.
Yeah.
Now that's a factor in deciding where to produce, in deciding where to source inputs. There's also a push to produce at home. So you look at all of this, and it suggests a somewhat higher rate of inflation and thus interest rates than we experienced in the decade before COVID. Now, just to be sure, we don't see inflation getting out of control. We're not talking about going back to the 70s and 80s. I mean, first of all, trade volumes, even though they're slowing down, they're way higher than they were back in the 70s and 80s, as you know. The second thing is technology, right? We've got still improvements in technology. Right now, it's focused on AI. That should continue to enhance productivity, which should provide an offset to this. But having said that, inflation and interest rates, and this is the point, as you know, should average higher levels than they did before. Let me put it another way. I think the US economy has demonstrated they can handle policy rates much higher than 1% that prevailed before COVID. Where's it going to settle? We think somewhere between 3 and 4%. I should remind people when Paul Volcker, who I worked for, that's how long ago I worked at the Fed, when he left, and everybody is, heralding him as the guy who slayed inflation, inflation was over 4%. So I think if the economy grows at a modest pace and inflation's 3 to 4% and it's stable, the Fed's going to cut rates.
Mm-hmm.
Okay. Let's just talk about the other parts of financial markets, bond yields. Okay. 10-year US Treasury yields for a decade before COVID average, believe it or not, and Bob knows this well, between 1.5% and 3%. I don't think that's going to be the case anymore. I think we're in the sort of mid to low fours right now. I'd say the range over the next several years would probably be with a bigger budget deficit, higher inflation. I think you're talking about 4 to 5.5% for 10-year US Treasuries. The stock market, I'll just say a few words. I'm almost done with this. The stock market seems fairly priced. Now, a lot of people might be shocked by that because it's risen over 50% in the last year and a half. But I think, and that pace is clearly unsustainable. But I think people forget that happened after a 25% drop between December 2021 and October 2022. So if you look at the last 2.5 years,
Yeah.
despite the That, by the way, that was because everybody expected a recession. We ended up avoiding a recession, and over the last 2.5 years, the S&P is up about 17% over 2.5 years, despite the fact that. So that's not that crazy. Now, where do I think? I think the productivity enhancing investments in AI will probably continue to provide somewhat of a boost to stocks, but I think still high interest rates, a slower economy is going to sort of mitigate overall stock market gains going forward. And then I'll just say a last thing about the world, because I've just mostly focused on the U.S. We all know the U.S. has been massively outperforming all the major economies in the world. I do think that remains the case, but the gap is narrow. We've talked about this before. You're starting to see some growth in Europe and the UK. Although it's picking up from very, very weak levels, like flat to down. China clearly continues to suffer from the after effects of a credit and property market bubble. But if you look at the rest of Asia, it's really picked up. And a lot of that is because the dollar, its currency depreciation against the dollar. You look at the dollar yen's gone up by more than 50%. The yen has appreciated that much. So you're seeing a big boost in exports in Asia that I think is narrowing this gap. So
part of that,
why don't we get to
part of
Q&A?
that global diversification of sources too, I would think.
That's right. That's
Vietnam
exactly
has
right.
been picking up a lot of manufacturing.
Yeah,
So I see.
that's
But
right.
this new normal you talked about in terms of interest rates has consequences,
Right.
and no one knows the banking business better than you,
Yeah.
Bob. You are about to launch a fund that would be investing in regional and community banks. I think you told us the last time there are about 4,200 of them around the country, and how important they are to local economic development and growth. You're about to launch a fund that's going to put your money behind your point of view there, which is a fund to invest in those banks. I think you're going to launch it in the next month or so. What do these higher interest rates portend for that investment and those banks that you think still have plenty to go?
Jimmy, you're right. We think this is profound. We think we're going to see a restructuring of the U.S. banking industry outside of the top 20 banks, those 4,200 that you referred to as regional and community banks. Interestingly, what got us here, the regulatory reaction to SVB and First Republic and that intrusion, it's made many of the small community banks too small to succeed with the higher regulatory and technology costs. I think that shock in interest rates from 0 to 5.5% turned the treasury portfolios of all banks upside down. That'll work out over time. But it also had a big impact on the loan portfolio, particularly those banks with a high percentage of commercial real estate. So here's the thesis. If we can identify 5 to 10 really strong regional banks, put equity in, preferred, we become influential and board members. And the capital levels get to very robust levels because we can mark to market and we can address the issues in the portfolio and the issues in the interest rate portfolio. Then think about the go forward. It could not be better for banks. As Larry said, if interest rates are 5.5% trending to 3 to 4, all banks operate better with high interest rates if they're marked to market on everything in a declining environment. And two, we've never seen
I mean a rate declining environment.
Rate declining environment. And we've never seen more loan demand and demand for lending than we're seeing now. So if you have a strong regional bank that can acquire in an accretive manner some of the
to find efficiencies,
banks immediately efficient,
yeah,
and have a go forward environment of 5 to 5.5% rates trending to 3 to 4, and loan demand as we have not seen for 4 or 5 years, it's a perfect environment for banks. We're going to see consolidation, and it's going to be very positive, and it's going to be endorsed and supported by the regulators.
And that's the point, Bob. Not everyone wants to play in this sector because of what you just said.
Yeah.
It is highly, highly regulated. But you've grown up in that world. You've lived and run that world. So you feel very comfortable in that highly regulated environment?
Yeah, this is not for the faint-hearted. This is not for investors who have never been in banking and have never been in highly regulated environments. But I saw my partner, David Seamus, involved in IndyMac post the 2008 crisis.
Sure.
As you know, we were able to acquire the US business of Lehman Brothers during the worst of that disruption. And the relationships that we've built with the regulators over the time are not only incredibly solid, but it's allowed us to bring people like Eric Rosengren, the former president of the Boston Fed, in on our investment committee. Larry Kantor, who's not only an expert on rates and the environment, but also worked with Paul Volcker during a high inflation period. So we have a team that is very comfortable having worked for their parts of their careers with the regulators or with banks in a highly regulated area like myself, or David, who's been an investor in banks throughout his career. So we feel like the next 2 to 3 years is going to be profound. We think it's the most interesting period for US banks that we've seen in decades. And we think the spin-off effects of being a part of this ecosystem in terms of capital relief trades, spin-outs of commercial real estate portfolios, restructuring of interest rate portfolios is something that any investor has to be watching very carefully.
And Larry told us that there's going to be a real push. We already had legislation that's going to cause infrastructure expenditures. And now if we're going to be reshoring a lot of business to diversify those supply chains, that's going to require capital. That seems to suggest that those banks that you're investing in are going to see even greater loan demand than they're seeing right now. And you're saying it's at really robust levels.
Yeah, it's interesting, whether you're in private equity, whether you're in the corporate sector, the demand for lending or commercial real estate, the demand for lending from banks has never been more impactful. And so many of the banks are offside in terms of capital levels because of the higher interest rates and the loan loss provisions, that there's less supply, more demand. And again, imagine a strong regional bank buffeted with capital, able to acquire accretively the too small to succeed, and the go forward market for them with higher interest rates, declining over time, and high loan demand. Couldn't be better.
Wow. Well, it sounds like you've timed everything quite perfectly here with this new fund. Congratulations on that. To summarize what I've heard from the two of you this morning, and please correct me if I'm oversimplifying it, which I'm sure I am. We see prices stabilizing, Larry. We see goods prices flattening out a little, correction in some of them, coming down even further than flattening. The labor market seems to be getting back to new normal with job openings at 8 million, where it was 12, and 7 being what you said was the normal. We've seen a slight uptick in unemployment, which is getting closer to the norm. Bob, you told us the new norm is not the last 10 or 12 or 15 years, but the 4 decades before that in terms of interest rates. And Larry, you said you see, I'm interpreting here, inflation in that 2 to 4% range. It's not going to be perfectly flatlined. It's going to gyrate a little bit. And you see growth this year at 2%. That sounds like you expect, Larry, that the Fed, who you and Bob have been a fan of, in particular Chairman Powell, you think that they did the right thing in saving the economy in March and April of 20. They were a little slow to slow things down when it got really jazzed up when the boomerang came back after COVID started to ease a bit. And now you think they're going to act perhaps this fall, you said as early as September, but not this summer, because they don't want to make that mistake again. They want to be steering this economy to the place they want. And it sounds to me like you think they have a glide path, barring the unforeseen macro issues, to do just that.
Yeah, I mean, I think that's largely right. I mean, if you look at their macro forecasting, it hasn't been great. I mean, they were sort of with the street that we were, they were late on inflation, as you said. Probably wouldn't have had hike rates this far if they started earlier. And they were also late on the way down. And they thought there was going to be a recession, which didn't happen. But I would say overall, once they got it, it was a little late. They acted appropriately for sure. I mean, we did need, especially when it was late, catching the inflation. We did need the rise in rates for sure. And they've been right to stay on hold, even though even when markets were pricing it in. So I'd say their performance over the last year has been a lot better. You know, obviously other things helped. I mean, we talked about the effects of COVID and goods prices and all that. A lot of it was sort of beyond their control. But I think things look, as you were saying, pretty good. You know, this sort of glide path, 2%. I mean, look, at some point we are going to have a recession. It just doesn't look like it's imminent. I mean, nobody's destroyed the business cycle, right? You know, it's still there, and it could be that the Fed cut rates and the economy takes off again. Like the other thing I would worry about that I think there's a risk is this the stock market getting too excited about AI and overextending. I mean, you go back to the tech cycle in 2000, the market was right that the internet was going to change everything. But
they were wrong on timing.
Well, it wasn't just timing. There were every stock that had anything to do with the internet was bid up to ridiculous prices. And so we had the crash and there were winners and losers. That could happen again. I'm not predicting it, but we could get over excited about AI and stocks would go up a lot. So
I would emphasize two things that Larry said. One is normal is 4% Fed funds, not below 1%. And two,
and that dictates everything else, the 10-year borrowing cost. But you pointed out recently to me in a separate conversation, Bob, that this is a better environment for banks to make money because and for well-financed companies, because our cost of borrowing is still 2-3%. Whether it was when the Fed rate was 1 and we were only earning 0.5% on our savings, and now we're earning 4.5% on our savings. So the cost of borrowing hasn't changed that much in real terms.
Yeah, and I think I would also say not only was 4% the normal, but as Larry pointed out, guess what? The economy behaved pretty well with rates going from 0 to 5.5%. So it wasn't a crisis. It wasn't a recession. Of course, we will have another recession, but the economy's performed pretty darn well.
Well, Larry, you told us over the last couple of calls that we've had sectors that have gone through their corrections. And we've had like rolling recession, and that may have wrung the excess out.
Well, I think in terms of the economy, that's part of what rolled the. In other words, the interest rate sensitive sectors got walloped like they always do. It just didn't spread to the rest of the economy because of the stimulus and an unusual labor market job shortage. Mm-hmm. And you're right. I mean, you look at the increase in household wealth, and there's not this excessive speculation and leverage yet that you've seen in the last 2 recessions have been just excessive leverage and speculation. You're not there yet, and that's comforting. But that doesn't mean we won't get there. That won't happen. But it's we don't see it this year for sure.
Last question for both of you, and I ask you this every call for the last 3 or 4 now, and that is the haves. There seems to me there are two populations in this country: people who are doing well, comfortable, so they can absorb the 20% cost inflation that they've experienced in housing, fuel, and groceries. But what about the half that's paycheck to paycheck that seems to have gotten walloped? What are the signs in this environment that you just painted a really clear picture of for us? How does that impact the half that's paycheck to paycheck that is feeling that 20% inflation?
Right. I'll just say 2 things here. One, economists, policymakers focus on inflation. That's the rate of change in price, and they should. Yeah. You want to stay away from deflation. You don't want inflation to be high and volatile. You want it to be stable. But we need some inflation. However, what do people care about? They care about price levels. When you get a surge in inflation and then it comes back down, the level of price is a lot higher for a lot of things than it was a few years ago, and that's upsetting. But there's a second thing. You look at those COVID stimulus packages, a lot of them, the child care tax credits, the stimulus checks, the extra unemployment insurance, all were focused on low-income people. All those, and they did very well. We had a huge decrease in income inequality. I think child poverty rates fell by half during this period. Those programs all expired. So you're going to be feeling, and a lot, as I was saying, those excess savings that built up have been drawn upon. So those two things, higher price levels and not having that big support, which was
Yeah.
temporary, is making them feel worse. I think those are the two big factors
Which
as to
has
why
electoral
this.
consequences, I'm sure.
Yep,
Okay, I
it
said that
does.
was the last. I lied. Here's the last. You often talk about, both of you, about demographics and their consequences on economies and politics. We just saw a lot of reports out of Europe that you talked about before, Bob, with the rally we've seen there. But Italy is shrinking its normal population. France is population shrinking. Germany dramatically shrinking its core population. And now, Larry, you pointed out to me a couple of weeks
China.
ago, the U.S. is now well below the replacement birth rate. So last, what should we think about? We hear you both in terms of where we're going. I'm getting my checkbook out to invest in this regional banking fund. It's launched at Atlas Merchant Capital. And what else should I think about when I think about demographics and its longer term consequences?
Yeah, so I'll just say this, looking at this from a purely economic point of view, which I tend to do, not political point of view, there's an anti-immigration sentiment. We know the border's a mess and all that stuff, and it's not just here.
It's
One
everywhere.
reason the UK election happened was immigration. I mean, France, the immigration is a big thing. However, right now, as you said, so the birth rate in the US has gotten way below, like, to keep population stable in the US, you need about 2.1 babies per woman of childbearing age. We're down at 1.6, 1.7 in the US. It's worse in Italy. It's low in China. Almost every developed country has this population. In addition, we had that big baby boom generation right after World War II, and they're retiring. Right now, more people are retiring than entering the labor force. These programs we have, Social Security, Medicare, Medicaid, all the transfer payment programs depend on the opposite, that we have the workforce pays for this.
Yes.
And when you have the return, so we never need more immigration, legal immigration, than we do right now. So
legal, underline legal.
Right. So there's only three solutions to this, right? Raise taxes, which nobody wants to do.
Slows
cut
the economy.
benefits.
No one has the political will to do.
Right, which includes increasing the retirement age or whatever. It's either coming or open the door to more immigration. The U.S. has a huge benefit because everybody still would rather come here, despite all our political travails, than anywhere else. So I'm not talking politically. I'm just talking about from an economic. These programs will run out of money over time unless one of those three things happen.
So you two had me feeling pretty good again. And now you just
that's long term. That's long term issue.
I can sleep tonight, but a couple of years from now, not so good.
Yeah.
Well, guys, you're terrific. You shine a light on things that we all have questions about. You make it understandable for us. You give us the things we should have on our radar screens and dashboards as we go forward. So we see a stabilizing environment. You think the Fed's doing the right thing by signaling September, and they'll probably do a 0.5 point in cuts over the course of the few months beyond September. Inflation coming in pretty good. You said something, Larry, I'll bring up on our next call, which is we need some inflation. We just don't want too much. And that's a different way of thinking about things than I had heretofore. So thanks, guys, for a terrific quarterly update call. I learned a ton, and I'm seeing some wonderful comments here from our community who get to enjoy your predictions, your outlook, and your insights each and every quarter. So thank you very much.
Thank you, Jimmy.
Thank you.
Thanks, Larry.
Thanks, Jim. Thanks, Bob.
My pleasure.